YouTube, what's up, man? It's your boy Richardson from Minimum Wage to Millionaire. If you're new to the channel, welcome. If you've been here, welcome back. So today, I want to lean more on investing, specifically telling you guys and helping you guys learn what a stock is, why should we invest in stocks, or why are stocks one of the investments that most investors commonly invest in, and what are the benefits and pros and cons of stocks. So I want to make this clear up front. I'm not a financial advisor. I'm not a stockbroker. I'm not here to sell you anything. I'm not here to tell you anything. I'm just here to explain and educate you guys on what stocks are and how it may be beneficial to you, not telling you that you should do it. So please feel free to speak to a financial advisor or do your own research before you invest your money. And like all investments, you do run the risk of loss to principal. So make sure that you thoroughly go through your options before you spend your money on them or invest in them. So with that out of the way, what is a stock? A stock or share is essentially a piece of a company in terms of ownership. So when you hear the word, I own a share in a company, let's just use the word Apple. We'll use Apple as an analogy throughout the video just to keep it consistent. So when you hear someone say, I got some stock in Apple, or I got some shares in Apple, what they're essentially saying is that I own a piece of Apple, the company, right? The $4 trillion plus company. And by you owning a piece of the company, you also are entitled to a piece of the company's profits. So you always hear the terms that when people talk about, you always hear the saying that, the companies only care about the shareholders and the shareholders are first priority. Well, there's a lot of truth to that. In fact, it is true. These companies have a fiduciary duty, especially if they're publicly traded, meaning that their stocks are available and accessible to the public to be able to buy, like Apple's. They do have a duty to prioritize and make sure that the company's best interest aligns with the shareholders. So if you buy a stock, you are a shareholder or an owner, a part owner of the company, right? And the more shares that you have, the more pieces of ownership that you have. Now, you'll realize soon enough, if you go on Apple, you'll see that it's a $4 trillion company and it has hundreds of millions of shares. So you owning one piece of share of Apple does not mean like, oh yeah, I'm hey, Tim Cook, like me and you are like this. Like, clearly not. There's institutions and other players that own a lot of shares of Apple, but you get the gist. So when Apple posts a profit, whether they decide to pay that in terms of reinvesting back into the business, meaning that the share price of the company goes up, meaning let's say you buy the stock for $100 and let's say in a few years it's $125, well, you made $25 of profit. Now, you don't realize those profits, or you don't actually get those profits until you sell the shares, meaning that you go to a public exchange through your brokerage account, think Fidelity, Vanguard, Robinhood, whatever, and you say, you know what, I want to get rid of this share and I want the share price of 125, which is what it's valued at. Then you share it. Your cost basis, which is what you paid for, was $100. You sell it for 125, you got $25 of profit. Now, because everything is taxed by the government, right? Wherever you make money, however you make money is taxed, so you will be subjected to tax with that. But essentially, that's how you would, benefit from being shareholder. The other way is through what's a dividend. And a dividend is just the company themselves saying, you know what, we want to pay out the profits directly to our shareholders. So usually on a quarterly basis, there's usually a period where they will see, okay, what is our profits for that quarter? Who are shareholders? Who own our stocks? And depending on our profits, we'll divvy it up and you'll get, let's say, 20 cents of dividends, or 20 cents that will pay out to the shareholders per every stock you own. So let's say you own 100 Apple shares or 100 Apple stock, and they pay out 20 cents per stock, you're getting $20, right? So that's kind of the thing. That's another way that they could directly just pay that to you. So you can get paid from owning stocks, through appreciation, meaning just the stock price of the share of the company goes up, in which now it's more valuable, and if you want to sell that way, you could do that. Or you could get paid directly through dividends, where just by holding on to the stock, you'll just receive dividends, usually on a quarterly basis, but maybe some companies do monthly as well. So that's kind of the idea. And obviously, this is all predicated on making sure that the company that you're investing in is of good quality, whether it's a company that's growing very well and hopefully sustainably, whether it's a company that's already well established and very powerful, like I said, Apple, right? Yes, Apple is still growing, but for the most part, they are a very mature company. They've been around for decades, right? So they have a lot of strong fundamentals that assures you to invest in stock. So there's alternative ways that you can invest in terms of your philosophy. There's people that will do what's known as trading stock, meaning that they'll pretty much just go by the share price of the stock, they'll buy the stock low, and then they'll try to sell it high. I'm not here to tell you guys what you should or should not do with your money, because again, I'm not an investment advisor or financial advisor. I'm not here to give you financial advice. But that is the most risky way to invest, typically, because there's a layer of this that you don't know, which is you don't know what the future is. You don't know what the future holds. So if you're buying in, trying to buy in low and then trying to buy high, well, what if it's not high? What if it goes low and it continues to go deep and continues to go deep? Again, the share price value will go less and less, which is ideally what you would want in that scenario, because you want it to go high and then sell it for profit. But if it goes less and less and less, that means you bought it higher than you're selling it for, which means you're at a loss, right? And obviously, that's not ideal. Another way people invest is what's known as dividend investing. So we broke down earlier how dividends work and whatever. So there's a layer of companies, they call it blue chip, which are valued companies. Companies, again, like I said, well established, good fundamentals, good profits on a consistent basis. People would just invest in them, and then instead of selling their shares when the stock goes high, instead what they'll do, they'll just hold on to those shares forever. And then the dividend payouts, because typically those mature companies do pay higher dividends than like the tech stocks and stuff, which don't pay dividends because they invest back in the business. You'll just sit and wait, and then every quarter you'll just get the dividends that way. And it's almost like getting a paycheck from the companies that you own, right? So there's a lot of value that comes with that, and a lot of people that invest that way. And then there's some people that invest in kind of somewhat of a hybrid approach, but more towards the trading, which is they buy growth stocks and they're banking on the massive growth of those companies, like new tech startups, new AI companies that are going to revolutionize the future. They're banking on those stocks to really grow their portfolio exponentially, right? So you have those people, and typically those companies, because they're small, they're going to reinvest their profits back in the business, so they won't pay a dividend, but the value of that stock will grow up exponentially, and there's people that bank on that. So that's usually known as growth investing. What I do is a fourth option, and I might do a follow-up video explaining to you guys my overall investment philosophy, which I touched briefly in my investment video, but I might go a little bit deeper and further in that. But index funds investing is essentially you're buying a fund, a basket of stocks. So instead of you individually picking out the stocks, you could buy an index fund, which is usually a fund that tracks a particular index that you want to follow. Let's say the S&P 500. The S&P 500, in case you guys don't know, is the 500 largest companies in America by market capitalization. Market capitalization is just how valuable the company is. So when you buy an ETF that tracks, or an index fund that tracks an S&P 500, you're pretty much making a bet that America's largest 500 companies are going to continue to thrive and grow, right? And when you buy an ETF in that, instead of buying the 500 companies on an individual basis, you're just buying that index fund and you're getting that diversification. And that's the main benefit, diversification, right? You're spreading your risk across all these other stocks that track an index. Another thing is great is that because it tracks an index, you don't have to maintain and keep up with it. You just kind of let the market do what it does. You kind of let other buyers, other investors, because that's what the market is, buyers and sellers, right? There's times where the buyers are more, and if the buyers are more, right, then the demand of the stocks go up. But when the sellers are more, then the price of the stocks go down. So That's typically what happens in the market. And when you buy an index fund, you typically are saying, hey, you guys decide, you guys figure that out, figure out what companies are valuable or not, and then I'll just kind of passively let, invest in that index fund and then get that diversification and everything. So that's pretty much it with stocks. Again, just to give you a quick rundown, all investment has some level of risk. Stocks are typically more risky, or some of the more riskier investments, because again, the markets fluctuate. There's sometimes more buyers, more sellers. Just everything. There's a level of things that are beyond your control when it comes to the stock market. So you have to just take all those things into consideration. But it also means you own a lot of, growth and a lot of profits, because again, as a shareholder, there's a fiduciary duty on the behalf of the company to make sure that you are getting and receiving those profits, which is very beneficial, because if a company continues to grow, scale, or if a company is already mature and maintains, well, you'll get a piece of that pie as well by owning stocks and shares. And again, how you decide to invest, there's a plethora of different ways, as I mentioned in the video, and maybe even some more ways that I haven't even mentioned, but that's just giving you guys the surface. So thank you guys for tuning into the video. Maybe in the next video or the next investing video, I'll tell you guys, I'll reveal what I particularly invest in. I kind of gave you an idea in this video, but I'll go a little bit more in the next one. Thank you guys. Richardson from Minimum Wage for Millionaire. May the Lord be with you all today. You guys have a nice day. Thank you.